This past year, I doubled my money in the stock market, and I'm going to show you exactly which stocks I did it with. For new investors and new viewers, hopefully you find some interesting stocks, and for long-time subscribers, treat this as an update on the portfolio. We're not going to be able to get too in-depth today because we just have so many stocks to cover, but make sure to subscribe if you haven't already for in-depth research on stocks that could 2 to even 25x. Let's do it. As a finance YouTuber and all finance YouTubers, if we're talking about stocks, we should probably show the performance of our portfolio. And I'm not talking about just isolated screenshots or putting it on a spreadsheet where as a viewer you can't verify anything. I'm talking about a serious, legit check. So a like on this video is a like for more transparency amongst finance YouTubers because I think it's really important. So in this effort of transparency, I've been showing my portfolio since it was at 30,000 to now over 140,000. And of course, this is with adding money over the past year. That's not all gains. And I really value my relationship with you, the viewer, so I do also want to note that this portfolio I'm showing you is most of my money in the stock market. It's actually the majority of my net worth, so I'm really putting my money where my mouth is here. So I'll just tell you right now that the account is fortunately up 125% over the past year. I started this account almost exactly 1 year ago, so that's our first year performance, and if you trust me, you've been a long time subscriber, you can skip to this timestamp right here to get right into the stocks and updates. But if you're new or you just want to verify, no problem. Did I actually double my money? Let's get into the legit check. So the account I've been showing publicly has the last 4 digits of 1051. I can't show the whole thing for obvious reasons. And you'll see as I review this, all the positions will end up matching what you see here. I just covered the stock names to avoid spoilers. This is a photo of my portfolio performance as automatically calculated by Charles Schwab, my brokerage. In the bottom middle left, you can see the last 4 digits of the account matching at 1051. So this is no BS. Then to the right, you can see that over the past year, the account is up over 125%. And this type of calculation cancels out the addition of any cash, which means that if I add, say, 30,000 to a portfolio that's starting at 30,000, that doesn't count as a 100% gain. That's actually canceled out by something called a time-weighted return, and that's what we're using here. And the only reason this says 57% gain is because this is only for the stocks I currently hold that I haven't realized the profits on yet. I've taken profit on a few stocks this past year, and every time I add more cash, this gain loss is obviously going to get proportionately smaller. Now going back to performance, YTD or year to date, which means since the start of 2021, this account is up 17.3%. So we are actually slightly outperforming the stock market this year, despite that crash in growth stocks and being primarily a growth investor. Finally, every single buy and sell that I make is documented in real time with reasoning in the investor community, previously my Patreon. You can check that out in the link down below if you like. Anyways, now let's get into the stocks. The first stock up 288% is Upwork, ticker UPWK. Upwork is a platform that connects freelancers, agencies, and contractors with enterprises, individuals, and employers. When I initially bought in around $14.42 per share, it seemed severely undervalued, and it would be a crucial business if lockdowns pursued. And that, of course, happened to be the case. Over the past year, 94% of hiring managers and their organizations used remote workers. 56% say it worked better than expected, and 62% believe their work will be more remote than pre-lockdown estimates. Now, I'm not kidding myself here. Of course, these tailwinds won't last forever. A lot of these workplaces actually that said, hey, we're going permanently remote, are inviting their workers back into the office. However, I do think that this past year has actually increased Upwork's TAM as they have found more and more organizations who are more comfortable now with hiring freelancers. I'll remind you that Upwork already has a massive opportunity in what's called the gig or freelance economy, which is estimated to be $1.5 trillion. On top of that, I believe companies are giving more and more trust to freelancers because 85% of Upwork's gross sales value, or GSV, was from larger engagements and complex projects. So gone are the days of freelancers just doing small tasks or monotonous work. Sometimes that still happens, but now they're getting serious responsibility, or they have been, but they're getting more of it. Supporting this belief is the fact that freelancers are increasingly high skilled. 50% of freelancers provide highly skilled services versus just 45% the year before. The key understanding is that Upwork can only be as strong as the freelancers on its platform. Without digging into the numbers like you usually would on this channel, I am happy to continue holding Upwork as it's still expected to be a high growth company into the next year and beyond. However, starting a position here does carry a bit more risk now that it's trading at higher valuations. I'd originally brought in when it was trading at a price to sales of 4 to 5x, and now it's at 16.88x. So just be aware of this when sizing your position. Next up is NIO, ticker NIO. This is a fan favorite. I bought this one in late July of 2020 for $11.80 per share. NIO is really my play in the EV space, and I kept the position small at just 1 to 2% of the portfolio originally because it was and still is quite speculative, and it's grown to be over 4% today. If you don't already know, this company produces electric vehicles with autonomous driving capabilities. They are developing battery swap infrastructure, they have NIO Power, and they're often considered the Tesla of China. NIO is creating a high-end lifestyle brand with their cars, and there's a lot more that I can talk about, but I would just refer you to this video right here that I made originally when I bought it. So people often ask, why not Tesla? At the time of purchase, Tesla was already at over $1,500 per share going off of pre-split prices, and it was also trading at a bit of a higher premium in terms of valuation than NIO. So after looking at the business, I went with NIO. And comparatively over the past year, that actually ended up being a pretty good choice, as since then, Tesla is up about 130% since then, which is still amazing, and NIO is up 288%. Now we reveal my largest position in the entire portfolio, Celsius Holdings, ticker CELH. If you're a long-time subscriber, this is no surprise. I actually just made a video on this, literally the video before this one, talking about how I think it could realistically 25x from when I originally purchased this stock. So because I just made that beast of a video, I'm just going to say it right here. The simple thesis is that I think we have the next Monster Energy on our hands. Celsius is a relatively healthier alternative to today's normal energy drinks like Red Bull and Monster, and they're also going after a different type of marketing strategy and demographic. The business continues to grow incredibly fast, and their marketing is just now really kicking into high gear in my personal opinion. I know energy drinks may sound like a weird investment at first, but oftentimes the weird ones sometimes make a lot of money. And just try the drink for yourself, compare it to other energy drinks, and you may be a bit more convinced. After Celsius is our final 100% gainer left in the portfolio, and that is CrowdStrike, ticker CRWD. In 2011, CrowdStrike set out to reinvent cybersecurity for the cloud era. Over the last decade, the CEO and co-founder George Kurtz, who previously worked at McAfee, built CrowdStrike into the #1 ranked modern endpoint security 2020 revenue market share in IDC's worldwide market share report. Wow, that was a mouthful. But the point is, they have incredible market share in cybersecurity. As a subscription-based business, they realize $1.19 billion in annual recurring revenue, or ARR, as of April 30th, 2021. If you think about it, the world is only moving more and more towards technology, so in my opinion, cybersecurity is a pretty good place to park your money. That said, CrowdStrike is trading at a very high valuation, being a cybersecurity play, a SaaS business, high margins, high growth, and they're continuing to execute flawlessly. But this high valuation means that if they have one misstep, it could be very painful for the stock price, so just keep this in your consideration. Keep this in mind consider this when buying it. What? Next, we have a stock that has truly tested my patience, and that is Maxar Technologies, ticker MAXR. Maxar is an aerospace and defense company that builds satellites and provides 3D satellite imaging. It has been one of the most wild rides I've ever been on as a shareholder. In the past few months alone, they have dropped over 20% in a single day twice. Both happened on the day of their quarterly reports, but conviction has been strong. On their last drop, I made an exclusive video for investor community members about how management continued to stick to their plan, and the drop was actually an overreaction in my personal opinion, yet again by Wall Street. Let's retrace this stock's journey for a second. It dropped 24% in a day in November after earnings, then rallied over 150% to a peak in January, then dropped 49% from that high, and 28% of that drop was in one day in May after their Q1 earnings. And since then, it's rallied over 47%. What's crazy is that both times after it cratered, following a quarterly earnings, insiders at the company, like the CFO and CEO, bought just 4 days after it dropped 24% in November, and then they bought again right after their most recent drop in May. This shows me massive confidence from management because insiders only buy for one reason. Now, since buying into this over a year ago now, or about a year ago now, I've been talking about Worldview Legion. The launch date for Worldview Legion was originally September 2021, but now they've pushed it to Q4 of 2021. On the bright side, they've signed contracts with 4 international allies for Worldview Legion and their 3.0 architecture, which is key to the eventual ramp in Earth intelligence revenue over the next few years. Now, I originally bought into Maxer about a year ago because I wanted exposure to space. I think that's the next frontier, and I like the business and what they were doing, but I also largely bought into this position because of its valuation. And now that it's trading a bit closer to its peers, and considering space and satellites is a tad out of my circle of competence, I don't know, I think that this one may be a position that I start to trim down, or if I see a really compelling opportunity, Maxer may be the one on the chopping block to leave the portfolio in exchange for a new position, because I do want to keep my portfolio relatively concentrated. As of now, everything's fine, and I think the Worldview Legion launch could provide a very great catalyst for the stock if everything goes well. If it doesn't, well, it would be a catalyst, but in the bad way. This next stock has been moving so quietly under the radar, not even Maxer satellites could pick it up, yet the gains have been immense, and that is Callaway Golf, ticker ELY. I bought Callaway for a good legacy business that was now adding a high growth business segment in Topgolf. When they made the merger announcement, the stock cratered 24%, and that's roughly when I decided to start buying in. Personally, I thought the merger was a great move. I was a bit confused by the drop in Wall Street's reaction. If I had to put it in an analogy, stay with me here because this one's a bit odd. Not one of my strongest analogies, but you know Chicken Wars, where you're in the pool and you got like someone on your shoulder and then like you go like fight each other like Chicken Wars? So I guess Callaway, the legacy business, would be like the person on the bottom. And they're super strong, super reliable, hard to take down, always, has a great performance. But they have no one on top, no one to sit on their shoulders. So Topgolf is like the best chicken war shoulder person in a 20-mile radius, and now they've teamed up with Callaway. Yeah, you get my point. You have a base and now you have an accelerant. Let's just put it that way. Anyways, on top of that, I also recognized a potential lockdown play as I realized a lot of people were going to play golf because it was outdoors, you could distance, and you could just have fun. This gave Callaway's core business a record-breaking year, and I continue to hold this bad boy confidently because every single time I see Topgolf posted or every time I go myself, it is absolutely packed. This is a photo from the one that's closest to me. And I even talked to someone who works in event sales at Topgolf, and they said they were so overwhelmed they had to hire 15 more people. For the sake of time, we'll be speeding things up now. Next up is the Trade Desk, ticker TTD. The Trade Desk is a play on programmatic ads, which is essentially the automation of selling digital advertising spots. It allows its buyers to target a specific audience in real time with data-driven analytics. And in today's day and age where data is the new oil, add on the fact that this stock is extremely healthy financially, and the Trade Desk is a nice one to own. They also recently had a 10-to-1 stock split, meaning for each 1 share of TTD you have, it has now become 10 shares, but the share price is also divided by 10. So, for example, if you had $1,000 worth of TTD stock, you now have 10 times the number of shares, but it's altogether still only worth $1,000. Now, what do I think about this split? I'm a bit neutral on it. 10-to-1 is kind of high, but it does help increase liquidity potentially for the stock, and it also lowers the price so more retail investors can get involved. Just remember, if you're analyzing the stock, if you see a big drop in EPS or earnings per share, it's likely because of the split, because earnings stay the same, but the number of shares you're dividing by has just 10x'd, so EPS is going to fall. But I did find an interesting article saying that William O'Neill, founder of IBD, said a stock will often reach a price top around the second or third time it splits. This would be TTD's first split, I believe. Also in recent news, the Trade Desk launches in India to tap into its digital advertising ecosystem internationally, and this could be a big catalyst for the stock moving forward as well. Our eighth stock is Square, ticker SQ. Square is another stock that I think has been covered pretty well on YouTube, and you may be familiar with it. The company began banking operations with Square Financial Services with the primary purpose to offer business loans and deposit products in conjunction with Square Capital's existing product. They also acquired 80% ownership ownership in Jay-Z's Tidal music streaming platform, along with licensing deals with major record labels and recording artists. Pop culture has honestly been a huge part of growing Square's Cash App, but I think Dorsey may have a different endgame in mind that we are yet to see. Finally, Square may be a sneaky reopening play, as their POS systems or point of sales systems are still out there and they take a cut of every transaction. Number 10 is Facebook, ticker FB. This one saw quite a little run over the past few months, and the one thing I really want to talk about today for Facebook is Oculus. I purchased an Oculus Quest 2, for research purposes of course, and it is absolutely incredible. It genuinely feels like you are in a different reality, and the tech continues to impress me. I believe Oculus could eventually contribute significantly to Facebook's revenue, as they could expand into things like VR concerts, VR meetups, lifelike avatars, and much, much more. This article suggests that Oculus could be responsible for more than doubling Facebook's Q4 non-ads revenue. So Facebook gets 99 to 97% of its revenue from ads, but their non-advertising revenue increased 156% year over year in Q4 2020. And we can't quite pick out exactly how much of that is because of Oculus, since it's clumped in with a lot of what's called other revenue streams in Facebook's other revenue. But we can see that there's a massive move in Q4, which just happens to be the same quarter that the Oculus Quest 2 was released.
Coincidence? I think not!
Now we're getting into some of the newer stocks in the portfolio. Number 11 is Upstart, ticker UPST. This is a stock I first mentioned in my stocks to watch for 2021 video, and it's also one of my newest positions in the portfolio. Upstart is leveraging artificial intelligence to improve personal loans, get accepted faster, more frequently, and at better rates. And I know AI is just a buzzword and often not taken very seriously anymore because it's thrown around everywhere. But the founding team is all ex-Google, and they're not just applying AI to their loans. They've leveraged AI in their marketing as well, which tells me that they plan to use AI in every part of their business, not just the product. This is a little screenshot of Upstart's Q1 transcript, which I annotated for the members of investor community. Clearly the company is in a hyper-growth stage with 157% growth expected for 2021. And don't be surprised if this 32.8% is too low come 2022. I'm hoping for it to fall below $100 so I can buy some more, and I'm staying very patient here. I genuinely believe this is a uniquely powerful opportunity and company in the personal lending space, with meaningful opportunities to expand into adjacent categories such as auto loans. And they're actually doing just that with their recent acquisition of Prodigy Software, which they call the Shopify for car dealerships. Another annotation screenshot from investor community shows that they expanded their auto refinance production from a single state to 33 states as of last quarter. I'm excited to make a deep dive video on this one soon, so again, make sure to subscribe. Coming in at number 12, we have Zora, ticker ZUO. Zora powers the subscription economy. What that means is they power the subscription management software for DocuSign, Zoom, Zendesk, GoPro, and many, many more. So if you believe the world is moving more towards subscriptions, this could be a stock for you. I did a whole video on Zora on my channel, and I was actually in the red with this position for a while, but we had conviction, we averaged down, stayed patient, and since that video, it's up over 33%, and the position in the portfolio is at 13% today. Again, this could easily go away tomorrow, but I'll still be holding. Zora's last quarterly report didn't really have any fireworks, but it was just good work. It was just execution by management, and I will admit Zora may be a bit of a slower moving stock in terms of its fundamentals, and I think I may have gotten in a bit early on their turnaround story before they really start to get going again over the next couple of years, but I'd rather be in it early and ready and waiting than to try and time it and potentially miss the move. This next one is not too new to the portfolio, but perhaps new to this series. We have Tattooed Chef, ticker TTCF. This one is popular as heck here on YouTube. You can probably find tons of videos on it if you want to learn more, and you can check out my personal thesis on why I invested in it up here, up in the right side of the screen, I think. Yeah. There were allegations of some shady activity over at Tattooed Chef Management with the gifting of shares and a lot of just weird circumstances going on. And what I say to this is, again, take this information and apply it to yourself. If you think that this is too shady, you don't want to be involved, you don't have to be. You can sell the stock. Or if you think, it's kind of shady, but you like the business otherwise, then maybe you trim your position and you can just hold a smaller percentage of your portfolio in this stock. So you're reducing your risk by doing that, right? You're reducing your exposure, essentially. Or if you are unbothered by this, then no one's making you sell. You can, heck, buy more if you want to. I mean, none of this is financial advice. I'm just saying, take that information, apply it to yourself, create your own beliefs, don't just listen to other people, and apply it to your portfolio. Closing in on the last three, another one that's been here for a while is Teladoc, ticker TDOC. Teladoc has been perhaps just as crazy as Maxer, and this one I am slightly disappointed, to be quite honest. They've been missing earnings expectations, fundamentals have been progressing questionably, and in hindsight, I think I got into the stock for the wrong reasons. Some are also arguing that telemedicine has started to become commoditized, which is essentially where people care more about the price as the main differentiator instead of who's providing the service or product. And this is as a result of a lot of different telemedicine competitors emerging, and also the threat of Amazon taking things national. I initially invested in Teladoc because I had originally invested in Livongo, a different stock that ended up merging with Teladoc. So Teladoc absorbed Livongo, and Livongo standing alone was a fantastic business, and it was a great investment for us on the channel. So a large part of my initial Teladoc thesis did actually depend on Livongo and that merger, but it looks like management has not been able to really take advantage of this deal and make it meaningful for the business. If management continues to underdeliver, I may have to rethink this as a long-term investment, but for now, I'll give them a couple more quarters. Next, we have the second to last stock here, Alibaba, ticker BABA at number 14. Baba is just too attractive at these levels in my personal opinion. I've been buying this one up slowly to reach 5% of my portfolio, and now we're almost back in the green. Every metric seems to be telling me that it's undervalued right now when looking at price to sales, price to free cash flow, and price to earnings. They're all trading at or near 5-year lows. That said, revenue growth has declined since 2018 from a peak of nearly 60% CAGR to a recent low of 31% CAGR in September of 2020. However, that is still very high growth for a company of this size. And I want to touch on more of the risks in this part of the video, so I'll also say there are risks in buying ADRs. The Alibaba stock that I own, and you may or may not own, on the New York Stock Exchange is an ADR, or what's called an American Depository Receipt. ADRs offer us US investors a way to purchase foreign stocks in companies that might not be available otherwise, but you technically don't actually own Alibaba shares. Common risks or disadvantages include potential political risks, especially with China, voting right issues as shareholders, and foreign currency exchange risks. But all things considered, I like Baba at 5% of my portfolio, and I think it should be able to reach a fair value of what I think is about $300 per share pretty easily. And to close it all up, we have PLBY Group, or Playboy, ticker PLBY. Oh my goodness. Oh, we are definitely in the hole on PLBY, but as I mentioned in my original video on this stock, in giant text on the screen, again, it was very risky because of the valuation. A lot of people say something speculative, and that usually just means they didn't do enough research. But PLBY was actually speculative at the time of the video because of the price, and I also said to be really volatile because of the low float. So by price, I meant valuation, and by low float, it's just a low number of shares on the market, so it's going to move up and down very quickly. Well, since then, they did another offering and put some new shares on the market, which will not only raise significant chunks of cash for their balance sheet to make new acquisitions, but also help increase liquidity and hopefully ease that volatility a bit. And as it gets cheaper, it just becomes better value. So I've bought up some more shares on the dip, most recently at $36.59 per share. But again, I want to keep it at 2% or less of my portfolio for the time being, because its success also depends on consistently strong acquisitions from management and continued popularity of the Playboy brand. So those are the 15 stocks that have helped double this portfolio in the past year. Many I've held on to for a year or more now, and some are new that'll hopefully continue this upward trajectory of the portfolio. And I do realize that 2020 was an incredible year for investors. I've personally been investing since late 2018, and I started this portfolio to document my journey on YouTube and again get that transparency, but definitely do not expect over 100% turns every year in the stock market. That's just not realistic. What I personally would think is good is 10% consistently every year. That's really impressive and hard to do over a decade or several decades. Personally, I'm aiming for 20% returns or more. Sometimes I'll hit it, sometimes I'll surpass it, and sometimes I won't meet it. But hopefully the goal is to be consistent and consistently beat it, of course. If you found any value in this video, and I hope you did, please make sure to hit that like button, subscribe, and check out a quote of the day. You might just learn something. Make sure to follow me on Instagram for daily posts about my portfolio, stocks I'm watching, and all that good stuff. And if you're watching to this point in the video, you are the real MVP. Don't forget your peace and thank yous.